Hello everyone, welcome to the session of financial accounting. Today we'll discuss the fire insurance claim theoretical aspects. So in the business organization, they will face several risks, and one among them is loss of property and stock on account of calamities like floods, cyclone, fire accident, etc. So in the present economic system, such losses need not be borne by the organization. The burden of loss can be shifted to another person. The person who agrees to bear the risk of loss arising on account of loss of stock, property, profit, etc. due to certain calamities and compensates such loss is called insurer. Right? We are having different type of insurance. So the insurance company they will compensate if you are having the insurance policy with them. Right? So one of the policies fire insurance. So this is also based upon the agreement. The insurance company they will compensate the loss of the business if it is in the nature of calamities. Right? The person who has suffered the loss and shift it to the insurer is called the insured. Right? The customer will be called as the insured and the company will be called as the insurer. The consideration for which insurer will take up the burden of loss is called premium. And the accounting provisions are the loss for which claim can be made could be for loss of stock or loss of profit. Right? So this chapter will focus on claim for loss of stock. Now the claim for loss of stock, for calculating the amount to be claimed from the insurer for loss of stock in fire accident, stock on the date of fire must be ascertained. If books of accounts are properly maintained and updated, and if such books are not destroyed in the fire accident, stock on the date of fire can be ascertained, fire books of accounts itself. However, if the books of accounts are not updated or if they are not available on account of being destroyed in fire accident or for any other reason, stock on the date of fire can be ascertained preparing memorandum trading accounts with the help of the following steps. So the step 1, preparation of trading account. A trading account is prepared for the preceding year of fire for the purpose of ascertaining amount of gross profit. So this step is necessary when ratio of gross profit is not given. And step 2, ascertainment of rate of gross profit. The rate of gross profit is ascertained by using the following formula. Rate of gross profit equals gross profit divided by sales into 100. And step 3, preparation of memorandum trading accounts. So memorandum trading account is nothing but trading account prepared to ascertain the stock and the date of fire accident. It is not prepared as part of double entry system, hence it is called memorandum trading account. So this is the format for trading account, memorandum trading account. So first particulars amount, then credit side particulars amount. So debit side, it will start with the opening stock and purchase up to the date of fire, then expenses on purchase, direct expenses if any, wages, etc. Then credit sales up to the date of fire, and then stock on the date of fire, and so this will be the balancing figure, and we will get the differentiated value as a gross profit. Now for preparing the memorandum trading account, the following information is required. Opening stock at the beginning of the period, then purchases up to the date of fire, and sales up to the date of fire, then direct expenses incurred if any, and then gross profit. Then for step 4, assessment of actual amount of loss. So from the stock on the date of fire, the actual amount of loss must be ascertained. The actual amount of loss can be ascertained using the following format. So it will start with the stock on the date of fire, list goods saved or salvaged goods or salvage or scrap. Then add expenses incurred for extinguishing fire if any, and then actual amount of loss. So here the salvage, the term refers to the realizable or realized value of the stock saved from fire. And last step, ascertainment of claim amounts. So for the amount of loss incurred, the claim must be calculated. Calculation of claim depends on the extent of insurance on the value of goods. When the stock is properly insured or over insured, the amount of claim will be the same as the amount of loss. So when the stock is underinsured, in this case, if the entire stock is destroyed, the policy amount would be the amount of claim. If only a portion of goods are destroyed, or if the actual loss is different from stock fire, the amount of claim can be calculated using the following formula of average class. That means amount of claim equals policy amount into actual loss of stock divided by stock on the date of fire. Now, what is the average class? So, average class refers to a class included in an insurance agreement for the purpose of discovery. Under insurance of stock or any other assets, when the insurance policy includes average class, the claim admitted by the insurance company is calculated using the above mentioned formula. So calculation of claim for loss of stock can be summarized into the following steps. So first we need to prepare trading account of last year if problem requires it. So calculate rate of gross profit on sales, prepare memorandum trading account and ascertain the stock on the date of fire, then calculate the actual amount of loss and then ascertain the amount of claim. So thank you. We will see you with the next topic.